Welcome to the Deep Dive. We cut through the noise of corporate announcements and all the technical filings to give you the critical context you need.
And today we're really zeroing in on the final moments of a massive industrial transaction.
We're talking about Hillenbrand, Inc.'s impending acquisition by Lone Star Funds.
The focus is entirely on tomorrow, January 8th, 2026. That is the day Hillenbrand shareholders hold their special meeting to vote on this proposed $3.8 billion take-private merger.
So our mission today is to distill the core terms, unpack the history that makes this vote so contentious, and analyze the numbers the board is using to defend the deal.
Right up to the finish line.
Okay, so let's start with the deal sheet. Hillenbrand, ticker HI, is set to be acquired by an affiliate of Lone Star Funds. It's an all-cash merger.
Which means if this thing passes, you get cash, and Hillenbrand is gone from the NYSE. It becomes a private company.
And what's the number?
The definitive agreement locks in a price of $32 net cash per share. And based on all the shares and debt, it pegs the total enterprise value at about $3.8 billion.
Now, when this was announced back in October, that $32 price was a pretty big jump, right?
Oh, a huge premium. We're talking a 37% premium over the unaffected closing price back on August 12th.
And I saw it was even bigger if you look at the longer-term average.
Exactly. If you smooth it out over the 90-day volume-weighted average price, that premium jumps to an even more impressive 53%.
So that cash premium is the board's main argument. They're saying, here, take this high-certainty exit.
Realize that value immediately. And if the vote passes tomorrow and all the regulatory stuff clears, they expect to close by the end of Q1 2026. It's a classic private equity move.
But to understand why tomorrow's vote is not, a guaranteed yes, we really have to look back at the company's recent history.
Hillenbrand has spent the last 5 years trying to transform itself. They call it becoming a pure-play industrial company.
And this wasn't just a small change. It was a fundamental shift in what they do.
It was. They systematically got rid of legacy businesses to focus completely on advanced manufacturing.
Like what specifically?
Highly engineered processing equipment. Think durable plastics, food processing, recycling solutions. The whole company is now basically built around their advanced process solutions and molding technology solutions segments.
And they did a bunch of acquisitions to bolster that, right?
Yeah.
Shape Process, Linksys Crew.
Exactly. They really cleaned up the portfolio.
But it's that cleaning up process that's causing all the anger now. We have to talk about the ghost in the room. Batesville division.
Oh, yes, Batesville. The death care division. This was the historical bedrock of the company, tracing back to 1884, and they finally sold it off in 2023.
And that sale created a very specific, and I'd say very painful memory for long-term investors.
That's the perfect way to put it, because back in December 2022, before the sale was announced, HI stock was trading at $44 per share. $44.
Okay, so they sell this huge division. What did shareholders get? A big special dividend?
Nothing. No special dividend. The proceeds went primarily to reduce debt and strengthen the balance sheet of what was left.
So fast forward just 2 years, and now those same shareholders are voting on getting taken out at $32 a share.
And there it is. That's a 27% haircut from that pre-Batesville sale price.
So even though $32 is a big premium over the recent price,
the contrast is just brutal. $44 2 years ago versus $32 cash today. That is the entire emotional and legal fuel driving these shareholder lawsuits. They feel like they took the hit, did the cleanup, and now they're being sold out at a discount.
That's a crucial distinction. The difference between the unaffected price premium and the historical price discount. It explains everything.
It really does. Now, pivoting to the buyer, Lone Star Funds. These guys are not, some small-time shop.
No, they're a massive global private equity firm. Founded in 1995, they specialize in these kinds of complex, asset-heavy situations.
They manage something like $95 billion in capital. They know how to execute these operational turnarounds.
And their CEO, Donald Quinton, he's been pretty clear. The plan is to partner with the current management, invest in the business, and foster growth.
It's the standard PE playbook. Take it private, get away from the quarterly pressure, and deliver those operational improvements that, frankly, are hard to do in the public eye.
But those improvements might never happen if the deal doesn't close. And there are some serious friction points.
Two major ones. First is the litigation. We have 2 complaints filed in New York State Court just last month. Grant v. Hillenbrand and Kent v. Hillenbrand.
We see this all the time with take-private deals. They're basically alleging the proxy disclosures weren't good enough and more importantly, questioning if $32 is really the best price.
Right. They're fishing for more information or maybe trying to squeeze out a slightly higher offer just to make the lawsuits go away.
Okay, so that's one hurdle. What's the other one?
The second, and this one is big, is regulatory scrutiny. This deal needs approval from CFIUS, the Committee on Foreign Investment in the U.S.
CFIUS. Why would a company that makes plastics and recycling equipment draw national security attention?
Because that highly engineered industrial equipment can be deemed critical technology. In today's climate, any transfer of key U.S. industrial manufacturing capability, even to a U.S.-based fund with global partners, gets a very, very close look.
That's fascinating. So there's real closing risk there, even if the shareholders say yes tomorrow.
A ton of risk. They have until July of this year to sort it all out.
All right, let's shift to the board's defense. How are they justifying the $32 price? I know they hired Evercore as their financial advisor.
They did, and the board unanimously approved the offer based on Evercore's analysis, and you have to look at the bidding process they ran.
It wasn't just Lone Star then.
No, not at all. Lone Star's first offer was actually higher at $34, but they dropped it to $31 during due diligence.
A drop like that is a bad sign.
It is. But then you had bidder B come in at $32.50, and bidder A was in a range of $28 to $32. So the final $32 price from Lone Star was a recovery, and it landed right in that competitive band.
Okay, so how did the bankers back up that number?
They ran three main analyses. The first is the classic discounted cash flow, the DCF model.
Where they project future cash flows and discount them back to today.
Exactly. And Evercore's model generated this. Well, this incredibly wide range of implied value from $28.55 on the low end to an astonishing $53.20 on the high end.
Wait, hold on. A $25 swing. A range that wide is basically useless, isn't it? It just feels like it covers every possible outcome.
That's precisely the point for you, the investor. That range is all about the assumptions. The low end uses a high discount rate and low growth. The high end uses a low discount rate and really optimistic growth. It just shows how much this deal is a bet on future execution.
So what about the other methods? The comparable company analysis.
Right, the comps.
Yep.
They looked at similar public industrial companies and applied a multiple range of 8.5 to 11.5 times next 12 months adjusted EBITDA.
And where did that land the price?
That implied a range of $25.85 to $42.15. Again, $32 is sitting comfortably right there in the middle.
And the third one was looking at similar M&A deals, right?
Selected transactions analysis, yeah. This gave a much tighter range of $29.10 to $39. So across the board, these three methods all paint a picture that says $30 is, a commercially reasonable price.
But there's always a but.
Yeah.
There's one piece of the analysis that the angry shareholders are clinging to.
And it's probably the most critical one. It's the analysis called illustrative present value of future share price.
And what did that show?
It suggested that if management just executes its own long-term strategy, the stock's present value should be somewhere between $33.35 and $46.95.
Oh, so the board's own banker's analysis suggests the current $32 cash offer is actually below the potential future value.
It is. It's slightly below the midpoint. And that highlights the entire dilemma for shareholders. Are you sacrificing future upside for today's cash certainty?
And that future upside is based on some pretty aggressive growth forecasts.
Incredibly ambitious. They're projecting net revenue to grow from about $2.4 billion this year to over $3.2 billion by 2030. But the real linchpin is margin expansion.
How much are we talking?
Adjusted EBITDA margin is projected to climb from 16.1% in 2026 all the way to 21.1% by 2030.
That 5-point margin jump is massive. That's where all the value comes from.
Right, that's where all the cash flow comes from. Unlevered free cash flow is projected to basically double in that period. Lone Star is paying $32 for the chance to execute that strategy.
Okay, let's move to our This Is Not Financial Advice segment. Given this binary event tomorrow, what's an outrageous but plausible trade idea?
You have to look at the asymmetric risk. The stock is priced as if this deal is almost certainly going through, maybe an 85 or 90% probability.
But the lawsuits and that Batesville resentment make a no vote a real, if small, possibility.
Exactly. So here's the pitch, and it's a bet on shareholder dissent. You establish a short position using very, very short-dated HI option contracts. I mean, options that expire like a week from now.
Betting on the vote failing.
Betting on the vote failing. Because remember, failing to vote actually counts as a vote against the merger. And if these institutions are angry enough, they might just sit on their hands or vote no.
And if the deal gets rejected, the stock price It doesn't just dip, it craters.
It immediately reverts toward its unaffected price, which was around $23.43. That drop from the high 31s down to the low 20s would give you enormous leverage on those short-dated put options.
It's a clean binary bet. You lose your premium if the deal passes, but the upside is huge if it fails.
A pure wager on institutional protest.
That is definitely a high-stakes play. Okay, let's wrap this up.
So tomorrow, Hillenbrand shareholders face this critical decision. Do they take the $32 cash from Lone Star?
An offer that has a huge premium over recent prices, but is deeply complicated by that historical memory of a $44 share price before the Batesville sale.
And despite the board's unanimous recommendation, the deal is still clouded by those pending lawsuits and the very real CFIUS approval hurdle.
So investors are balancing that certain cash in hand today against the potential for higher value in the future if those aggressive forecasts come true.
So, assuming the merger is successful tomorrow, here is our final provocative thought for you to consider. Private equity has promised they can execute a radical 5-year margin expansion, jumping from 16.1% to 21.1%.
A huge leap.
So if this deal goes through, how quickly will the new privately held Hillenbrand actually start hitting those margin goals? That execution is the key to justifying this whole deal, and the pressure on the new owners will be immense from day one.
A fascinating test case. As always, this analysis is purely for informational purposes drawn from public filings and announcements.
This is not financial advice.